There are investors who I'll use the term that they're bridging the gap. They sold a property based on an opportunistic sale. They didn't have a plan. They're struggling to find something that makes sense, especially in today's high interest rate environment. And so they're going to deploy capital into DST that's extremely conservative and stable with a short exit strategy, just to simply buy themselves more time. It's almost like, if you could delay your 1031 exchange for 3 years, would you do that? Well, this isn't exactly that, but in the mind of the investor, it's an opportunity to stay in the 1031 game, to continue to multiply and compound their tax liability for their benefit, ultimately for the benefit of their heirs who will receive a stepped-up basis. But you better believe what they're looking for in 3 to 5 years, it's probably not a DST. It's probably something in their local market, with their local broker. And so that's, something that we see all the time. What we'll also see today is a combination exchange where somebody, let's use a different case study, where an investor has a loan that's ballooning and it's just a great interest rate today, but tomorrow, when it balloons and they have to refi or pay it off, interest rate is completely different. They have to underwrite to a totally different NOI, to a totally different cash on cash, and their NOI isn't necessarily growing right now. It's a tough market. And so what they may do is sell the asset, reposition the debt into a DST, and now whatever the balance is, take that balance of capital and go into the local market, make a really strong all cash offer, and then close on that.
John, question for you. I am continuing to hear all this doom and gloom predictions that with the current interest rates, many commercial property owners are going to struggle to refinance their properties. And for them, refinancing is not going to make a lot of sense. Can DST provide any solution in that case?
Yeah, it's a great question. I mean, right now, we have a lot of loans out there that were issued 5 years ago. And if you did a 5-year interest-only loan with a balloon, 2025 is coming, right? And so we're seeing this laddered debt in the system that's starting to roll, and we're having investors that are quite nervous. They know it's going to take 6 months to list and sell their property, especially we're talking about larger commercial or larger multifamily investors here. And certainly it works in the single family. It's the same issue, just with a different multiple. But our larger institutional buyers or our higher net worth individuals who really leveraged the low interest rate environment 3.5 years ago to refi, I'm comfortable with exactly what is coming. It's because when they underwrite, their cash flow is significantly different, because a 4.5 interest rate and a 6.5 interest rate, that's pure cash flow profit. It's just going right back into interest. What we're doing today, and this is very active, very common conversation that we're having, is selling that property, repositioning just the debt into the DST, maybe in a higher loan to value, something at 60, 70, 80%.
Just the debt, repositioning just the debt. Expand on that for just like 3 sentences. Expand on that. How can you reposition the debt?
So every Delaware trust has a percentage that is equity and a percentage that is debt. There's a performing loan in the trust. And so let's just say it's a 50% loan to value. Okay. If you invested $1, you close on $2 worth of property. Okay. But now let's say that it's an 80% debt, 20% equity scenario, and you have an investor who has $5 million worth of bad debt that's going to balloon. Well, now we have an opportunity to say, okay, well, you could reinvest $1 million of your equity to close on $5 million of property, and you still have a balance of $750,000 that you can now go to the local market and redeploy in an all cash buy through that 1031 exchange. So that's where the DST market could just be a tool that a sophisticated investor is using to reposition what I'll call bad debt for a time. And the debt in the DST market is advantaged because the assets are significantly higher quality assets with higher quality tenants. So the interest rates are lower. Banks are willing to take a perceived lower interest rate is a perceived less risk for the bank. And so that does offer an advantage to the retail investor. And remember, the retail investor, they're not applying for this loan. They're not individually qualifying for this loan. and this loan is non-recourse to the investor.